Hello, Haley. We turn it, we push it down just a little bit. Oh, Joe.
What's up, big man? How are you?
Doing good. How are you? Will you bring it down just a little bit, like this?
I'm technically out of the Richmond office, but I do most of my business here in Lexington. Do you know what it is? We're in the Remax waters. Usually they're in there. Yeah, we might have.
Tap is fine.
I know. Which one do you want? They got beach plum.
I don't understand why people drink sparkling water.
You know, it's those of us that don't drink soda, it's like the closest thing.
We're in Kentucky, but we're opening a 10th location here next month, and we're building a branch.
What up, girl?
Joe. Hey, Joe.
How are you?
No, I'm from Michigan.
So, go. Okay. All right. Hey, guys. I want to introduce you to Mike Adams, Independence Bank. He's a commercial lender, and I felt like he was extremely important to hear from for a lot of reasons. If you've been a primarily residential realtor It's a great opportunity to learn how to kind of bridge the gap between your residential buyers and sellers who may have their own business owners, and are going to be either upgrading their business front, needing warehouse space or whatever, but ways that you can get involved with your residential clients in a commercial way too. So he's just going to give you practical ways of getting started and how that all works. So write down questions and keep questions for at the end. And here's Mike Adams, Independent Bank, guys.
All right, well, thank you all for having me. If you all online have questions, definitely put those questions, type them out, and I'll be answering them, as well as you all in the room. If I say something and you want to learn more about it or dive a little bit deeper, let me know, but I'll be doing a high level conversation just about commercial real estate, commercial mortgages, and, you know, just hopefully at the end of this conversation, you all will be more comfortable with dealing with it. So no one has experience, right, dealing with commercial real estate. Just a little bit. What's your experience?
Well, my family was under contract to purchase a commercial property that didn't work out, and I found my commercial listing.
Okay. Cool. So, what is a commercial real estate loan or commercial mortgage? It's one and the same. It's definitely different from a residential loan for a couple different reasons that we'll discuss some of those key points. But it's used solely for business purposes. How you doing? My name is Michael. All right.
I really didn't know.
So commercial mortgages are used specifically for business and investment opportunities. Okay? Residential loans are used, again, for home dwelling or, you know, some investment purposes, like if you're doing a secondary home. So typically, when we're looking at a commercial mortgage, it's a loan to a business, to an entity. It could be a loan to an individual. It just depends on the structure. This person is sole proprietors, depends on the structure, what's going on. But typically, commercial real estate can be, you know, if you're applying for a commercial mortgage, in terms of real estate, it could be owner-occupied or it could be for investment purposes. Owner-occupied is me. I'm moving in, I'm taking over a location, a business, I'm operating on behalf of myself or my company. Or for investment purposes, I'm buying a piece of property and leasing it out to somebody else. Okay, so those are commercial structures. So examples of that, you know, something that, or entities or assets that you would use a commercial mortgage for are retail centers, retail malls, shopping centers, office buildings and complexes, hotels, assets like that. Okay. So commercial mortgages actually finance the acquisition, development, and construction of those particular assets, and it's secured by the real estate itself. There are times to where if there's insufficient collateral value, then we'll look at other forms or other assets to secure that loan. So it's not uncommon to have one commercial mortgage secured by many properties. Just depends on the value of that property. Okay. Any questions concerning that?
I do.
Go ahead.
So, in residential,
Can you all hear me online?
Okay.
Okay, cool.
So I'll try to say my question loudly too. In residential, we have in progress loans that are usually refinanced at the tail end. So if someone were buying a commercial property that's going to need upgrades and they're financing that in, is that considered in progress? And do you refinance it at the end, same as residential? Or is it structured differently?
Yeah, so how we do with improvements to properties, which you're asking about, right? Yeah, so if you're looking, so typically based of finance, 80%, so we look at the loan to value, right? We'll land on, we'll figure out what the value of a property is through appraisals, and we'll land 80% of that, okay? That could include improvements. So we're looking at 80% of the value of the property or the loan amount, whichever is lesser, and then 80% of the improvements that you're wanting to do to that property.
So the 80% can be on the finished product after the improvements are done.
Correct. Correct. Okay.
Yeah.
But the key is you got to have 20% equity, your own cash into the and we'll talk a little bit about that, into the property. That's just we call it skin in the game. You know, so we're lending on 80% of that asset. We want to make sure that you have your own money into it. But that's a good question. So any other questions concerning improvements?
That's the same as residential.
Yeah, okay, cool. So let's talk about residential loans versus commercial mortgages, or residential mortgages versus commercial mortgages. So commercial real estate loans are usually made to businesses. We discussed that, entities such as corporations, developers, limited partnership, funds, and even trusts. Okay, residential mortgages are typically made to individual buyers. Commercial loans typically range from 5 years or less to 20 years, with the amortization period exceeding the fixed term of the loan. And as you all know, I'm sure everyone in here owns a home, the residential mortgages typically are fixed 30-year rates, right?
So you do more 5-year or something?
Yeah. So what we do is, so it depends, right? On average, you'll see a 5-year. We do ARMs. You'll see an ARM. You'll see a balloon. So an ARM is adjustable rate mortgage. So we'll fix it for 5 years, and it depends if you fix it for 10 years. It's just we look at, if you're using it for investment properties, and we'll look at the leases, that are for investment purposes. We'll look at the lease that's involved. If you sign a 10-year lease, then we'll more than likely, if it's a strong tenant, they've been around for a while, and we look at financials, they're strong. Yeah, we'll do a 10-year fixed ARM on a 20-year, 20-year amortization. If we're looking at 5-year leases, then we'll look at a 5-1 ARM. So an ARM is, you guys familiar with ARMs? Okay, cool. What about balloons?
Yeah.
Cool. All right, good. Thanks.
They're not very often. Yeah.
You don't see what?
The market changes very often anymore.
Yeah, we do both. We do, it just depends. I think customers like ARMs better for the lower introductory rate, but I think customers like ARMs better because after that, if it's a 5-1 ARM 20-year amortization, after that first 5 years, they don't have to refinance it immediately. They can just let it float because after that first 5 years, it just floats at prime plus 1% or whatever the bank, whatever the percentage point the bank wants to implement. A balloon is you have to refinance it. So if your business is in trouble in year 5 and you go to refinance property, it can be hard, to continue to do business with that bank. They say, hey, it looks like the organization in trouble. You have the same scenario on the ARM. You can kind of fly if they're not monitoring on an annual basis, you can fly on their radar and just keep making those payments as long as you don't miss any payments, late payments, not putting any red flags, the bank will pretty much leave you alone. But your banker, that's the point of having a real good business or commercial bankers, that person or she's going to always be engaged and involved in what's going on in your business so that, I can report back to the bank and say, hey, Tara, this is what's going on with Tara's business. We're safe, her debt service covenants, coverage covenants are not meeting the standard, but there's a pathway to get that back in order. And then we'll talk about debt service coverage as well. You guys are familiar with that.
Yeah, I did know.
Okay. So, and with commercial loans, you'll see it's very common that we put a prepayment penalty, which is very different from the residential world. You get a 30-year fix and you can go refinance it every year with no penalty. So commercials, you'll typically see language that says, for the first 5 years, you're committed to us, and we'll do a prepayment penalty of 5% of the original loan amount for the first 60 months. What I do, because I don't want to penalize a customer for wanting to sell their property, right? But if you go refinance, I'm gonna get that. I'm gonna hurt you a little bit. I'm gonna hurt you. So yeah. So the way that works, what I commonly do is I just say, 3% original loan amount if refinanced with another institution, so that if they go and sell it, you use cash to pay me off. I don't want to penalize anybody for making good financial decisions, especially if we get paid off fully. But if you're just shopping around, jump from bank to bank, we're a relationship bank. So, we want to make sure that doesn't happen. We're going to do our best on the front end to, win your business, to win your trust. And, they expect, there's a return associated with that. So we expect our return. All right. And so typically with residential loans, there's no prepayment penalty. Any questions concerning commercial versus residential? Okay. All right.
I don't know how we'll find out their question.
Any questions online? I think I can go to the chat.
I'm not seeing anything right now, but let's see here. If you have any questions, you can unmute yourself. Or
you can unmute yourselves if you want to ask a question. Hold on. Go ahead, speak again.
Now, I'm not seeing any questions right now. Tell them if they wanted, they could unmute themselves or throw it in the chat and I'll throw it out there.
I had a question.
Oh, Brittany has a question.
Do you feel like with COVID and the climate change of office buildings, kind of people moving to working from home, do you see a difference in commercial real estate right now?
One more time, with everyone working from home, a difference in commercial real estate?
Yes. Has there been since COVID?
Yeah, I think where we hurt the most in the commercial world is leasing office space, because everybody's working from home, and a lot of customers are realizing that, or a lot of businesses are realizing that their people are just as productive, if not more productive, by having people work remotely than at an actual, office location. So I think every business, and I think it's a responsible thing to do, is to re-examine if we really need brick and mortar, or if there's a way that we can have a hybrid model, because it's all about saving on costs at this point. So yeah, with the office space, it's a little bit hard to keep it booked. So in the commercial world, we'll be looking at office complexes, and it may be 60% occupied. What I mean? So we got to adjust in our underwriting with the understanding that, hey, we look at who's in there, how long the leases are, if they're, if we're projecting they're going to stay, if they're solid tenants, but, we have to settle for it. It's probably not going to be at 100% occupancy rate. Our new 100, maybe 80, maybe 70. So we're real flexible on how we underwrite those particular opportunities. Good question, though.
Thanks.
Any other questions? All right, let's keep the train moving. All right, so let's talk about who qualifies for commercial lending. That's another way to ask that question is, what does a bank want to see? How does a bank qualify an individual for a commercial loan? That's important for you guys to know as well, so that you don't deal with a lot of people that waste your time, right? When you talk to these residential prospective buyers, you've been doing this for a while. You know who's serious and who's not. You know who's wasting time, who's just bored or whatever, and who's and who's really somebody that you need to follow up with, that you need to pay close attention to. So so banks speak a language. The language that we speak, and I talk about this often, is creditworthiness, and there's 5 components associated that we evaluate when we're talking to a prospect or a customer about loans. Okay, so the first C is character, and I'll go into them. I'm going to tell you what they are. So it's character, capacity, capital, collateral, condition. This is the golden language of banks, right? So I tell people all the time, if you want to improve your probability of getting a loan from the bank, you got to learn the language that the banks speak, and you got to be able to speak that language in regards to the opportunity, your business, or whatever you're trying to do. So if you guys find a person, you want to understand who they are, what's their resume. For a bank, we're looking at credit history, we're looking at business experiences. You want to come and get a loan for us? Who are you? What's your experiences? What qualifies you for this loan? Let's dive a little bit into that. Let's check your credit history, because your credit history tells us how you manage debt. And it falls. That's about character. Are you taking out loans? Are you paying those loans on time? It's a character thing. So we want to make sure that whoever we do business with, we know and we can trust. All right. Capacity. Another word for capacity is cash flow. Okay. Banks are no longer collateral lenders. That really ended, the financial crisis we had around 08, 09. So you'll have banks who will lend on the collateral value of a property, those days are done. The banks will, collateral is a component of a loan, but we are cash flow lenders. So if we go and we lend money on an asset, we want to make sure that that asset or that business is generating enough income to pay that loan back itself first. Does that make sense? So cash flow. So when you guys are, looking at properties, like the question is, what type of cash is this? What's the potential for this property to generate cash flow? What has been the historical trends with this particular, this particular asset or property? Because that's very, very important to a bank. If it's been sitting vacant for a while, the person who wants to buy that property, they have to help, understand, okay, you want a loan to buy this property, it's been sitting vacant, what's your plan? So, the business plan helps with that. A person knowing their market analysis helps. So we really want to make sure that that property is generating income to service the mortgage that we're going to lend on that. Okay. Any questions concerning the cash flow? Yes, ma'am.
Hold on a second, go for those questions. Save you. No.
We're good?
Yes.
Okay. Capital. I just said the term skin in the game. That's what it's all about. How much you bring it to the table. One of the things that's different from a residential loan is on the commercial end, we don't lend 100% of the asset. We don't lend 100% on, loan to value. We typically are around 65 to 80%, depending on the opportunity. 80% is typically the standard. Okay. So whenever you got a customer that's coming and looking at a commercial property, you gotta let them know, like, hey, you have 20%, you got 20% to put in this thing. If they don't, it's probably not a person that you should take seriously because the bank is not going to waive that. Okay. Also, we look for something called post-transactional liquidity, which is a part of capital. So after you put your 20% down, how much cash do you have left over in case anything happens with that business or that property, something breaks? Do you have cash to come to fix it, or have you depleted your liquidity? And your probability is you'll come back to the bank and ask for more money on that asset, in which will be a red flag for us. So having that capital, the liquidity is very important. And again, you're looking at a commercial property, depending on what it is, the customer may be prepared to put 20 to 40% down. I get asked commonly, well, do you guys do non-recourse loans? We'll do a you familiar with non-recourse is? Okay. It's a loan with no personal guarantee. So I want a loan, I want that loan, the business to have that loan, I don't want to put my name on it as the individual. We would do loans like that. We do loans like that. And it makes sense when you're dealing with these large investors, we call them CRGs, certified rich guys, who has 50, 100 businesses, and for us to go and collect all the information and for them to guarantee everything is just a hassle. So what we do is we look at the individual asset, the individual project that they want to lend against, and if it's strong enough, and if they put 40% down, which takes us to a 6% loan to value, we can mitigate those risks.
What business type is usually acceptable in that scenario? So if they come to you with an LLC, are you going to give them the time of day for that kind of loan?
We lend to business structures like that. Like
any business structure.
Yeah, any business structure. Yeah. LLC, corporation, partnership. So it doesn't matter the structure. Even if it's a sole proprietor, it just has to make sense. So make sure that they got the 20 to 40% to put down. Non-recourse, if they're talking about non-recourse, they don't want to personally guarantee it, which they want to be having that conversation with y'all. They'll be happy with us, but we'll say, hey, you put 40% down, then we'll consider it. So most common industries that we see it in is real estate. We got these firms, equity firms, they come and you might have a company that have 10 owners. And not everybody wants to personally guarantee, the note. So if the project, the asset is solid itself to service the debt, and there's plenty of equity in our property, you got a case for non-recourse loan. Okay. You're not going to get a residential mortgage without signing your life away on the thing personally. All right. Any questions concerning capital Online, we good? All right. Collateral. Collateral is just the asset that we're talking about, securing a loan. So collateral is important because, again, we don't lend, we don't typically lend based on the collateral loan, but the collateral is very important because this is an asset that we're putting on the books, right? So we want to make sure we understand the condition of it. The condition is very important. Where is this asset today? Where is it going tomorrow? We want to understand the age, or what's the plans to renovate it or to make it better. We understand the age of it. What's the lifespan of the property? How old is it? The older the property, the more you're going to have. It's going to be wear and tear. The property has mileage, it's been around for a while. So you're going to have more. The older, typically, the more consistent issues you have with the property, right? On a commercial and commercial structures. We want to understand everything about the property as possible. We pull, PBA information because, again, before we put this asset on the books, we want to make sure that it's a solid asset. There's minimum risk associated with that asset, and there's no issues with the loan. Okay. Any questions concerning collateral? You guys are an easy crowd.
I have a question. Can the collateral be outside of the state of Kentucky? So if they're purchasing a rental Airbnb in a vacation area, can your institution lend for the asset that's outside of the state?
Yeah, that's a good question. So each bank is different. We're a Kentucky-based bank, 3.2 billion in assets, and I probably should have gave you guys the rundown on Infinite's Bank, but we've decided that we will lend outside of our state lines. But every bank is different. There are banks that don't lend outside of state lines. There are banks that said, "Oh, we really don't," but it depends on who it is, right? If you got a strong customer and they do all they're banking with you, and they want to buy a vacation home in Florida or buy a commercial property in Texas. I've done some Texas financing. And, if the relationship with the bank is strong enough, it's a person we trust, person got plenty of liquidity with us, we're their go-to when it comes to banking. Yeah, we'll do it. Some banks, they don't care. You don't have to have deposits. You don't have to have a relationship. If it makes sense, they'll do that transaction because it's a great opportunity. It's a good asset that they want on their books. And sometimes, sometimes when you build relationships with certain individuals, sometimes that's what your foot in the door looks like. They say, "Hey, take a look at this. I got this property in Ohio, this property in Tennessee. If you guys can finance that or refinance it, then I'll give you a look at, some other stuff." And so it just depends on the institution. Mm-hmm. You'll have some that will do it. You'll have some that say, "We don't go outside state lines." Good question. All right, and the last tenet is condition. Okay? Condition is just concerning the purpose and structuring of the loan. So basically with this tenant, you want to make sure that the customers is able to demonstrate that there is a market for the business and has a clear purpose for the loan, okay? So if somebody comes to you and they want to buy a building, but they can't tell you, market analysis and what they're going to do with it, and what the repayment source is and all that good stuff, then they don't really know what they're talking about. So that's a person you probably don't want to spend too much time on because the bank isn't going to spend too much time on. Okay. Any questions concerning those 5 tenets of creditworthiness? And all this information I'm giving you, you can find on Investopedia. It's online. It's out there for you. But I would, for the people you deal with, as you guys start to dive into the commercial world, you definitely want to make sure that they understand this because, again, with them being able to talk the language of the bank, it improves the probability of them getting a loan. Okay.
So it sounds like your approval process isn't necessarily a pre-approval process if you have residential. So if we have a buyer in commercial coming to you, we can expect that this approval process is going to take a while. It's not going to be where you start residential clients being pre-approved in 30 minutes. But your process is going to take how long?
So that's a good question. In the commercial world, there's really no such thing as pre-approvals. If somebody tells you that, they're full of not good stuff. So full of this is water, sprinkling water. So
So does that mean a commercial, someone that's interested in purchasing a commercial property, do they need to have a contract on a building already before they approach you to get it approved?
No. Well, yes.
Or have
we're not going
to.
to. Yeah. So let me walk through this. So residential world, you can go to the customer, prospect, whoever can go to the bank and get a pre-approval and approach you with a pre-approval. You know what their capacity is, how much they can afford, et cetera. So that's good. In the commercial world, it typically doesn't work like that because in the residential, they're getting approved based upon their income, their debt, you know, their personal finances. When you look at the commercial, there's different factors that come into play. It's me, but it's that asset. I'm going to pre-approve an asset in which I don't even know what that asset is and what type of cash flow that asset is going to generate. Does that make sense? So what happens is the customer typically always identifies a property. And then he has that conversation with the bank about that property. And from there, we get information about the asset, the cash flow, everything we just discussed, those 5 tenants. And then we, you know, get tax returns, we get all the financial information we need. And what I do is I underwrite it. And then if it looks good, I will give that customer a letter of intent. Okay. But this, you guys will already be involved in this process. You got a person that comes, they look at the property, they get up under contract, put their escrow down. They'll come and talk to me and say, Mike, you know, I got this property up under contract. Let's take a look at it. So that's how we progress from there. So it takes a little time, but it doesn't take long to get a letter of intent. You guys will look at the letter of intent as the pre-approval, but the letter of intent is just the bank. I mean, it really holds no value other than, you know, telling that customer that, hey, we're serious about doing a deal with you. This is what it would look like pending underwriting.
So
there's no legal recourse associated with it.
How long does that take? The letter of intent.
Oh, I can pop that out as soon as so the question is, how long does it take for the customer to get you their documents? That's the longest outside of appraisal, you know what I mean? Because they'll say they want to do a loan with you, but it takes them, you know, 3 weeks just to get you everything you need to start the underwriting process. Because what happens is I do what I call the sniff test. So I underwrite, so I get an understanding, you know, if this is a good deal, or if it's not, understand the strength and weaknesses of this customer, so I can communicate it to the bank. Because the bank hired me to go and find good businesses and bring them to the door. You know, and I serve as a middleman between this customer and the bank. I say, hey, bank, I need to do business with these people because of X, Y, and Z reasons, or we need to do business with them because of X, Y, reasons. The bank will say, okay, yeah, well, let's take a little bit deeper look into it. You know, and they'll ask questions. I'll be able to answer those questions from meeting with the client and get an understanding of, you know, their whole financial situation. And that's how we operate. So a customer that comes to us, they have to give me everything that I need in order to properly underwrite it, do the sniff test, and say, okay, I want to do business with Tara. You know, this is the scenario. Am I approved to give her a letter of intent? The bank will look at it and say, yeah, this is something that we definitely want to move into application. Letter of intent basically means from a bank, we want to move into application. But here's something to show you that we're serious about doing business with you.
As realtors, what do you recommend we do in order to kind of filter through those customers that, because we spend a lot of time going and showing them properties, kind of pre-negotiating things with the other commercial agents. And I mean, honestly, I question myself. Yeah. So it's like, I don't want to waste my time if I'm going to bring them to you and then you're going to say, no, there's definitely some red flags there. So yeah, what do you recommend for us? Are there certain questions we should be asking and just hoping people are honest with us, or?
Yeah, I would say if you're not wasting my time, if you're not wasting your time, right? So if they pass your sniff test, I would say that's when you want to send them to me. So I think from a commercial perspective, you know, you go on, you're showing a property, whether it's investment real estate or, you know, just a, you know, 1 unit asset, whatever the case may be, you want to understand who this person is, what's their experience, what qualifies them to, you know, come and bid or you know, take over this asset, purchase this asset. Do they have the cash? You know, again, that magic number, 20%. Do they have at minimum 20% down to put into this property? And you can put it on the banks. You can say, hey, you know, typically I just want to understand, you know, just let you know. And I don't know what if you dealt with banks before, but typically on commercial real estate, they're going to ask you to put 20% down with some post-transaction liquidity in case anything happens to this asset, to this property. Right. So you can understand who they are. You know, you'll know from somebody when they talk if they're legit or not, for the most part. If they got the cash to put into the deal, and then you do the warrant handoff to the bank.
What about a startup company who has only been working on their home? Okay, so they want to find their first brick and mortar building, couldn't find anything to rent, so they want to buy something. Are you looking at how long they've rented somewhere before they're ready to buy?
So the scenario is someone's working from home for themselves, working for a company.
Someone has had their own small business, working from home. They've run it out of their home thus far, and they want a commercial building to continue growing the business. Can't rent, so they're going to buy. They've never rented at that point yet, so they've run it out of their home. Do you look at that as a factor?
Not really. So I mean, it makes sense, right? So I think the question is, you know, how strong is this person's business? You know,
It still comes down to cash flow and
still comes down to cash flow. So if he wants to go and buy a building, it makes sense. He wants brick and mortar for his business, for marketing purpose, for visibility, for a lot of reasons why he wants that brick and mortar. So that there's nothing alarming about somebody's going from working from home, working remotely to actually wanting to buy a physical asset. The question is, again, going back to repayment source, can you afford it? You know, how well is the business doing? You know, can the business handle that mortgage? So I think that's what you want to kind of keep in mind as you're talking to those particular individuals.
Is inventory ever taken into consideration? Like how much inventory they would have on hand or something like that? Because you talk about retail and say somebody wants to open up a health food store or something and they have a bunch of inventory. Is that ever considered part of the business asset?
No, it's just business. Inventory is part of the assets. I mean, it's, you know, with inventory, we like to see what you have on hand and how long it's sitting. I mean, you know, if you got inventory that's been sitting for 8 months, a year, it means you're not selling something, right? So something's wrong, something's going on.
You may want to hide them.
Eventually, but not to. I know a lot of self-employed people, they have to write everything off for the taxes. My husband's in that situation where we have a company and obviously or more than we put on the paper. And that's kind of hurt us in other, like more like I think residential looking or things like that, because, you know, he may make $250,000 a year, but we write off, you know, 200,000 of that. Is that different in a commercial situation where you see, okay, but you know, or is it the same?
No, I would think it's the same. I mean,
okay.
I think what holds more weight to inventory is accounts receivables and accounts payables. How long is it taking you to get paid for something that you sold or a service that you perform? And so we look at accounts receivables age. As long as you collect them within 90 days, you know, we like that. Anything over 90 days is considered non-collectible. That's a problem. Right. So
we don't put it in if you don't pay.
What's that?
We have browser company. We don't put it in.
Oh yeah.
We're paid the day we're there. We're taking it back in.
Well, if you look at like I operate a commercial cleaning company, right? You know, sometimes it takes 30 days to get paid, right? Okay, sometimes it's 15. It just depends. The big guys, the bigger you go, they pay you whenever they feel like it. You know, they got the payable schedule, and you just got to follow them on that schedule. It might be once a month. It might be 45 days. Some manufacturers, they don't get paid till 60. I got a customer in marketing. Most of his receivables is greater than 90 days, but he's doing business with, you know, big entities, huge distilleries, and you know, it just comes along with it. So we do look at the industry, we do look at the trends in terms of the payables, receivables, and if it makes sense, we'll adjust. But for the most part, 90 days, after 90 days, non-collectible, right? Yeah, anything under 90 days will be looked at number.
For the established businesses, this is all fine. If someone is starting a new business, other than the credibility of the client itself, like you said, you know, their repaying capacity, etc. So what else would you guys look at? Do they need to provide a business plan? How do you what other things will come into it?
Yeah, so starting a new business, and one thing to consider when we're talking about starting a new business is we're talking about very, 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 very risky.
Mhm.
You know, unless it's a franchise, they're opening a franchise, and you know, you got the corporate guarantor of the parent company. But you know, Mike Adams want to go and start a business, and I'm feeling good about this. I got a little money in the bank, and I want to go buy a real estate. The bank is going to, you know, the bank is not going to be so favorable because of the risk. One thing, but that's thank God for the SBA, the Small Business Administration, because you know, for certain, you know, business owners that, you know, that check certain boxes, if you're starting a business, you can get an SBA guarantee as long as the bank, you know, does SBA lending, and the SBA will come in and say, okay, risky deal, we get it. We'll offer 50%, 80, you know, to 80% of our guarantee, partner with the bank to finance this opportunity.
Do you work with SBA? Independence?
Ooh, that's a good question. I'm ashamed for this answer I'm about to give you. All right. So no, we do not. We do not. We try to do everything in house. I think that we were a non-preferred lender once upon a time, and it was just it messed up our process. It was a bad experience for the customer, a bad experience for the bank. So we said, you know what, we're going to do our best to get everything done in house. And you know, if we can't get it done, it's just not the time. It's just not the opportunity for us. You know? So, but there are, you know, if you for startup businesses, I always recommend entrepreneurs to work with SBA preferred lenders, okay? Because with the SBA preferred lender, the bank actually does all, just to break this down as fundamental as possible, the bank does all of makes the decisions in-house. They do all the underwriting, it's their process, and all they do is check boxes for the SBA's in the form. SBA, make sure those boxes are checked, like, okay, we'll give our guarantee, and boom. So the difference between a preferred lender and non-preferred lenders, SBA is making all the decisions. So when you do anything with the government, who knows how long it takes, right? So sometimes it takes long, sometimes you don't know where you are in the process. Sometimes you don't even know the person that you need to talk to. So, you know, it's just a bad experience for a customer. And that's one thing that, you know, we have to do is manage customer experiences, because the customer don't care if it's SBA. We can't say, oh, well, the SBA, they're like, look, I'm doing business with you, what's happening? So we try to make sure that we manage our experience. I'm not saying tomorrow, you know, again, that's a conversation we'll be having because I'm used to being an SBA preferred lender. So there's some conversation we'll be having over the next couple of months about if there's opportunity for us to become a preferred lender and how to properly manage that process and manage customers' experience. But currently, we do not do any SBA lending.
So that would be the equivalent of being sort of like a local bank. So like when we're going to, if we're having, we have a difficult client who has self-employed or whatever working against them, we can go to a local bank who might take a more personal or emotional interest and then buying in the area. Would you say that's kind of the same?
Say that one more time.
If we had a client who was difficult to loan to, usually for being self-employed or maybe a bad credit score or a foreclosure at some point, we can go to a local bank who might take a more personal or emotional interest in them buying locally. Would you say that's the same thing commercially?
Well, so let's go back to the 5 C's of credit worthiness.
It's still going to come down to all that. You're not going to necessarily give someone a chance. Kind of thing.
No, yeah, we give chances. Don't get it twisted.
Okay.
We just don't do dumb things.
Don't get it twisted.
We don't do, you know, we don't land off of luck.
Right.
You know, we want to make sure that you know there's a story and that the financials and story merge, right? So we give people chances. There's, you know, I've done loans that got turned down. I got a couple in pipeline now that got turned down at previous institution that I was with, and we looking at it, and our approach is different.
Okay.
It doesn't make, just because they didn't do it, I mean it's a bad loan,
Right.
Because I'm not going to bring something that I don't believe in to the table. Because you know, we lenders, we have reputation. I'm setting up a whole bunch of bad deals. You know, that's going to, you know, the underwriter's going to be looking at me like, oh, here's my guy sending another deal. You know, they already got negative energy associated with what I'm sending up. So I make sure that's the part of the thing with the sniff test. That I make sure I do my due diligence before I send it up. That way I can have an intellectual conversation with the bank about, you know, why we should bank this particular customer or lend to this customer.
What are your interest blocks like? So if we have an extended commercial contract with extended due diligence time. What does that look like for locking in interest rates?
I think it's 45 days. I think it's 45. 45.
Did you ever have over 120? Can you ever lock in for under 20 days? No.
I can get you that answer though. Okay. Again, it's bank specific. So with this new bank, and I just joined Independence Bank about a month and a half ago. And before I leave, I'm gonna tell you just a little bit about Independence. Okay, I probably should have started off with that. I don't know with Independence Bank. I got to check the policy and see what our lock period is. But I don't know. Typically, it's like 45, 60 days, and you might see some banks that do 120 on a commercial.
Okay. I'll keep going with questions unless somebody else. Questions?
So let's walk. I'm gonna walk briefly through the commercial loan process, right, from point A to point Z, high level again. And, you know, if I say anything, you want to dive a little bit deeper into it, just let me know. All right. So customer identifies a property they want to purchase. They come to y'all. Y'all did a walkthrough. Cool. You guys want to move forward to me. All right. They may get them a contract. They may not. They may have the specs, you know, associated with the sale, and they bring that to me. It's not in contract yet, but I want to see if there's something I can really put a hard offer on. I can do that as well. So it doesn't necessarily, that's the question, doesn't have to be in the contract. No, but we got to have information on the property that they want to purchase. Okay. So the customer will call Mike Adams to inquire about financing. Okay. Mike Adams is going to talk through the opportunity with the customer and address each of the 5 C's of credit worthiness, so I can, you know, see how serious this person is or not, you know, see where they are. I will collect financials from this, financial records from the customer, which is the business taxes. We collect business, personal taxes, interim statements for the business, personal financial statement, and we get liquidity statements, which is like a bank statement, investment statements, things like that. Okay. If it's a startup business, of course, we'll need a business plan and a lot more information. But those are the basic things we'll need. Okay, so I'll get that information. I'll do some underwriting. If it looks good to me, I'll talk to the bank. Bank gives it a thumbs up or a letter of intent. I'll issue a letter of intent. Again, a letter of intent is a preliminary agreement with really with no legal recourse. This is basically saying, hey, we want to do business with you. We want to move forward into the application process with you. You can show, you know, your realtor that this letter of intent. They'll know that a bank is seriously wanting to take a look at this asset for you. So it will serve just like a pre-approval, but in the commercial world, because there's such thing as pre-approval, we have to go through underwriting. Okay. So letter of intent. So if once we get a customer letter of intent, if they agree, we look at the terms and say, hey, you agree, let's go into application. They'll give me permission to go into official application, pull credit. Go into application, pull credit, everything goes up to underwriting. Underwriting start doing their own spreads and analysis, and then I'll get those spreads and analysis back. I'll compare what they got to what I've had, and I'll address any, you know, any issues that I need to address concerning the underwriting. Okay. So after that, the underwriters will make a decision. They will decide if we're going to do the deal, if we're going to approve it, or if we're going to decline it. Or, you know, many times it's like, hey, I need a little bit more information. And so I'll go back to the customer and say, hey, I might have missed this. Can you give me this? Or I didn't notice this in my analysis. And so answer any questions that they have. Our underwriters at Independence Bank, they were all commercial loan officers. You don't see that anywhere you go with any bank. Typically, underwriters are just sitting there crunching numbers. But the good thing with having underwriters who serve in the capacity that I serve in is because they know the market, they know business, they know how to look for the story. You get what I'm saying? They look for ways to approve a deal because they've been in the seat before. Whereas what it feels as a commercial loan officer is sometimes it feels like a bank, an underwriter is automatically looking for a reason to, you know, to decline it. And that's very stressful. And bankers leave and go to other banks because if they feel like they can't get deals done at that particular bank. Okay, because getting deals done is associated with our success, with our money, you know, things of that nature. So you want to make sure you got a good team of underwriters who knows the market and who is looking for ways to get the deal done, opposed to saying, oh, no, it's not going to work, on to the next. Okay.
So from start to finish, if a buyer is diligent about getting everything that you request to them, how long should the process take from initial letter of intent to close?
So from letter of intent to close within 60 days. So what I say is from application until when I'm inputting the application system until the actual closing, 45 to 60 days. There's been times where I got them done in 30. Okay, if I'm going against the timeline for whatever reason, the customer needs to buy, you know, it's November, let's just call it November 25th, and he needs to close for financial reporting reasons by December 31st, then, you know, I'll take a look at it. If it's a strong deal, strong asset, I can put the application in and immediately order appraisal at the same time. What that does is save me about 10 days, right? Because it's going to take 7 to 10 days if I don't rush it. And the customer's in a rush to get a deal approved. You know, we got underwriters, but underwriters are looking at a whole bunch of deals, and it's a lot that's involved. And so they take one deal at a time. So if it's not a rush, then they're going to get to my deal the order in which it came in, okay? But if it's a rush, the customer needs to close by December 31st, I'll send the application. If it looks good, send the application in, I'll order appraisal immediately. That way it'll cut, you know, 10 to 15 days. Because commercial appraisal takes about 15 days. 15, 20 days, just depends how busy they are. I've never had an appraisal done within 15 days. How long is residential take?
Depends on who you get.
Yeah. Can be done. I have one done, ordered it, we got an offer, the appraisal was the next day. That's rare. Usually it's 10 days. When they order it, they same thing, but then when
you send a person a Valentine's Day card?
It was not my deal. I had the seller side, and she said FHA will be done in 3 weeks, maybe 2.5. And I'm like, there's no way, girl. Mm-hmm. And the next day she said the appraisal's today. And I'm like, what time? And it came back the next day. I mean, it was unreal, but it's rare.
That's the longest part of the process that we have no control over. That's the longest part of the process that we have no control over is the appraisal. The appraisal gets done when it gets done. We can't rush it. If the customers want to pay a little bit more, we can't rush it. But typically, we're talking about like 2-3 days max.
Is it tough getting commercial appraisers? I feel like when we were going through the process, like they put out a bid and had 3 people respond, and none of them were available for like 3 or 4 weeks.
Nope. We once we give someone a thumbs up, they get on it.
Mm. And the expense of that appraisal falls to the buyer, just like in residential.
Correct.
And how expensive is it on commercial as opposed to residential?
It's
like a square footage type of business.
Yeah, it does, square footage, all that stuff. So average, average we're looking around, 1,500. I haven't seen an appraisal more than $3,000. Average. My appraisals I send through, I'm probably looking at average deals around like 600 to $1 million, like average application. Of course, you'll have the 5 million, you'll have 100,000, and we're talking about $1,500 in appraisal. The good thing too is that if the appraisal gets too pricey, one thing banks do is we cap costs. We'll say, okay, we want to save a little money, so we'll waive the loan origination fee, which a loan origination fee is typically about 1%. Banks decide how much they want to charge, so we may waive it, we may discount that. We may just say, hey, $3,000. That includes your appraisal costs, that includes your closing costs, all in costs. So anything you have to do outside of that $3,000 is your down payment. So we're very conscious of the costs associated with doing closing deals, and we try to help the customer as much as possible. Because we're about to make money off of them for these 5 years.
Right.
That's right.
Okay, so where we start? Okay, so the underwriters, let's say they approve the deal, it goes up, I put the application in, they approve the deal, then I'm able to give the customer approval letter. An approval letter is basically saying that you've been approved at this rate, but hopefully the approval letter matches the terms of the letter of intent. That's what we aim to do, or it's better. You never know. So we get an approval letter, customer said, great, let's move forward. Then typically we'll order appraisal after that, title work. And after the appraisal comes back, the satisfactory title work comes back clean, then we'll start preparing loan closing docs and placing liens and get a closing schedule. Any questions concerning that process? I know it's very high level, but there's a little bit more engaging involved in it. It's good.
It's good.
All right, so Independence Bank, I'm sorry, Mike Adams. I'm originally from Pontiac, Michigan. I moved to Kentucky in 2003. I graduated from Kentucky State, had a job with Kraft Foods. I was in sales for a while, got promoted to market trainer. This was in Toledo, Ohio, and Southgate, Michigan. I started Miss Kentucky, moved back here in 2011, 2010, late 2010, and ended up getting in banking. So I started my career in business lending with PNC. I was with PNC for a while. Then I went to Fort Bank, about 4.5 years, and now I'm at Independence Bank. Independence Bank is a Kentucky-based bank, the 5th largest bank in assets in Kentucky with $3.2 billion. Just to give you a little comparison, Fort Bank is $1.4 billion. So we're more than double the size. Heavily, we're big in Western Kentucky. So we've been moving east. We're in Louisville. We've been in Louisville, I believe, 6-7 years. We've been in Frankfurt. Got a beautiful location on Versailles Road, about 5 years. We're entering Shelbyville now, so we'll be up and down the 64 corridors, and we're coming to Lexington. So we'll have a temporary location close to downtown, like walking distance. We got a lot of marketing. I can't disclose where we're going to be just yet, but within the next couple of weeks we will be. And then we bought property in downtown Lexington, so we're building probably 12 to 14,000 square foot building in downtown Lexington. It's not a great location. Yeah. So we're back. I think if I told you that, I'll probably give it away where our location is. That we're trying to get to?
No. We just hear who's selling. Real estate joke, it's fine.
We work with a couple, Jerry Schrader and Phil Hollaback. Yeah. So so with our bank, we don't necessarily, we're a true community bank. We're all about making sure we do what's right for our customers, and we try to find the top talent that we can find, and we treat them very good. We make sure they're having fun, because we know if they get up and they enjoy what they do, the production and all that stuff, the numbers, that'll follow, that'll come. But do you feel good and competent about what you do? Is there any resources that you need in order, for us to help you, and go out there, go hunting. So, we don't necessarily have a black and white approach to how we do loans or the industries that we bank. We want all the banks that still, we do equine lending. We just started doing that about a year ago. So we brought a guy named Ted Burge on. I don't know if you know Stacy Burge. Stacy was a VP. She's our market president, but she was a senior lender with Chase, and she worked for Fifth Third before, some other banks. But Ted is her husband, so they went and recruited Ted because we wanted to get into equine lending. He's like one of 5 equine lenders in the U.S. So we do equine loans, so that should tell you what no other banks do, we do, right?
So is that equine loans on like buying actual horses or horse properties, or is that
breeding,
the actual horses, right? Wow.
Buying, selling, breeding. Yeah, so we don't do like race.
No, right, yeah.
One stand on some of these have to be.
Well, I know, right? Yeah.
Yep.
That's the surge fees.
So yeah, we operate in a gray area. There's nothing that we don't really do per se. It just depends. We need to look at it. We need to feel it. We need to touch it. We need to understand it, and we'll do it. Prime example is we're getting into barrel financing. There's only one other bank that's doing it.
Oh, wow, that's a huge expense.
What's that?
Barrels.
Yeah, well, it's almost like real estate. This bourbon industry is huge, right? And so there's investors who's going and buying a whole bunch of thousands of barrels, and they'll buy it at New Lake for $900, and they'll let it age for 2 years and sell it for double. So the longer that juice, they can
office barrel.
I
had one. You can sign your name. It's expensive at the bottom of that.
No, you can buy a barrel for $900 to $1,000. New, fresh off the steel.
I don't have 10 years to wait.
No, you can 2 years. You can put the property. So again, I just say that to say, equine, barrels, we live in a great area.
Wow. So you cater to Kentucky.
What's that?
You cater into Kentucky with those businesses.
Oh yeah, for sure.
But it's our industry. So
that's right.
Cool. That's very cool.
That's right.
I have my neighbor does thoroughbred racing, so I was like, I didn't even know that existed in terms of equine. Blended.
Oh, yeah. Yeah, when we do a lot of it, you know, and we travel, our guy Ted, he travels all around, he's Michigan, he's New York, he's all over the place going, because he knows that world. So he's connecting and he's doing some big deals. Taking a lot of money right now for us. I'm scared of it. All right, any other questions online? Y'all good? Well, thank you.
Thank you.
Thank you.
Thank you. Thank you. Very
No problem.
Very.
Oh, there's supposed to be a good right.
Oh, hey, good one, Sarah. Okay,
I need my
so
number.
Tara, this was.
I need my number.
Okay. Okay, so how many people are here? What she said to draw through?
1 through 50.
Okay, so choose a number 1 through 50. Holbrook and Holbrook has donated this book to give away. So if your number wins, you get the book. So I don't know how you guys are gonna
Put them in the chat.
No, that's not it. Then
I don't know.
Type them in.
Can we just say a number?
I don't know.
23. That's my number.
Go around.
That is my number.
Everybody pick a number. Yeah, just say your number out loud. 43.
44 was my number.
19.
Right. Y'all
99.
come on and say your number. Oh, here we go in the chat.
37, 50.
Okay, 49.
Okay.
I see 37, 50, and 18 in the chat.
All right, Joe. Oh, Joe picked a number. Kathy, Brittany, Cindy, what's your number?
Sorry, 29.
Okay, Emily, what's your number?
Somebody go low.
1 through 50.
17.
17. Okay.
So
17 the lowest.
Yeah.
Okay.
That's my number.
All right, Emily, you won the book, baby.
She said, yay, she's standing in my office.
What was the number?
Oh, he's 6. The number was 6.
Oh my God, I said go low. I don't know.
I'll raise
Yeah,
the hand with you guys.
I always pick 20. I always still pick 23, 44. Even if I know it was 6 hours.
Very much.